Hello, this is Tim Congdon, Chairman of the Institute of International Monetary Research at the University of Buckingham. I'm talking at the start of 2019. I'm going to be talking about the economic situation and the monetary background to it. Now, the last couple of months of 2018 saw quite big falls in the stock market, and concern therefore about what might happen to the world economy in 2019. And there is indeed a slowdown in growth compared with the relative buoyancy of 2017 and early 2018. What I want to do today is to answer a very general question, which is, what are the determinants of asset prices? Obviously, stocks and shares are one type of asset that we care about their price. We also care about the price of houses, the price of commercial property and real estate, as they call it in America. And we worry about the price of bonds. And now this topic is rather badly dealt with in most macroeconomics courses taught at universities. In fact, many of these courses don't talk about the movements in stock markets or house prices at all. Perhaps it's because it's a little bit too capitalist and so on, and they don't want that. It's felt that students shouldn't learn about this kind of thing. Well, I'm afraid people do own assets, and the movements in asset prices are very important to their behavior. What the textbooks do cover, what is covered in a university macro course, is the behavior of the price of only one asset, which is a long-dated bond. And this comes through in Keynes's theory of the liquidity preference theory of the rate of interest. Now, I'm going to talk about that in the next presentation when I do next month, but I want this time to focus on something very different. I want to focus very much on the price of the stock market, price of stocks and shares, and house prices. Paul Samuelson, who wrote one of the great economics textbooks, said that the stock market had forecast, this is 1966, had forecast 9 of the last 5 recessions. Obviously he was making fun of it, and that general sneering, its contempt for the stock market is, I think, one of the reasons why it's ignored. But it's very, very important, and I want to show in the next few minutes that the changes in the prices of houses and the price of stocks and shares are far, far more important than changes in the price of bonds to consumer behavior and other types of economic activity. But there are various kinds of assets we can think about. We can think about buildings, we can think about planes, ships, cars, lorries. These are all physical assets that help in production. But often we buy and sell these assets indirectly through owning financial assets, which are just bits of paper that represent claims on these underlying physical assets. So there are two types of capital assets. There are physical capital, real capital, and there are financial assets, financial capital. And further, when we think about financial assets, there are two kinds that matter. Some kinds of financial asset just pay the same income year after year. The fixed interest assets, fixed interest bonds, we call them. There are other types of bonds, but I won't get into those. Essentially, most bonds pay a fixed coupon year after year. And then there are what we might call variable income assets, of which the main kinds are indeed stocks and shares, equities, and houses. And houses are a little bit difficult because obviously many houses are owned by the people who live there, so how can you say you pay a rent? Well, you can impute a rent, you can guess a rent that, and some houses are let out, they pay a rent. Stocks and shares pay dividends. Dividends and rent are part of national income. The income changes over time, rents go up, dividends go up. So these are growing income variable income assets. Sometimes, of course, the income could go down too. Anyway, the income is variable. It's variable income assets. So we've got these two types of financial asset: fixed income bonds, where there is a theory and it's part taught universities, and then the price of stocks and shares and houses, where the income is variable, and this is not the value of these, nominal value of these, is not taught in universities. Now, what are the most important assets in this sort of universe of assets we're thinking about? And I want just to look at American numbers in 2016, the end of 2016. Obviously, many other countries I could have looked at, but I'm going to start off with the United States. These sort of patterns are common elsewhere too. I'm not making these things up very much. Now, 2016, American household income was about $14 trillion, $14,000 billion, and household assets in total were about getting on for $107 trillion, about 7.5 times the size of income. People had some debt, you deduct that, and household net worth was $92 trillion, roughly 6.5 times income. Okay, now these kind of multiples, again, are very common. If you look at most European countries or Japan or whatever, 5 or 6 times is very common for this sort of stuff. Okay. Now that's then split. We've got a little kind of apple here with different slices. Let's look at the different assets that we've got. Real estate there, we've got equities, directly held equities, we've got this green slice is bonds, directly held bonds. They are 4% of US household wealth at the end of 2016, and that's all. So economic theory is concerned mostly with a rather unimportant type of asset. Now, having said that, this 4% rather understates the figure, understates the, let me just go into two quite important complications. One is that I'm going to exclude the national debt from wealth. You might think if you own a government bond, it's wealth to you, and that's fair enough. But actually, we, the people, have also got to pay taxes to pay the interest on the debt. And the taxes run out to 20, 30, 40, 50 years. So do the dividends, but so do the coupon payments on the bond. But you can argue that they cancel each other out. This argument was made by a chap called Robert Barrow, Professor Robert Barrow at Harvard University, and the proposition that government bonds are not net wealth is usually called the Robert Barrow's idea, the Barrovian idea, also called neo-Ricardian. If you think it's going too far, just think about the intuition behind this. Governments, of course, can pay for things honestly through taxes, or they can pay for them through having very large debts. Is the larger and larger debt really a nation's wealth? Of course not. And therefore, we're going to exclude government bonds, government debt from the whole analysis. The second one is that people may have a claim on a bond through having, say, an insurance policy or belonging to a pension or having being a beneficiary of a pension fund. We need to allow for that in the discussion, and in fact in America these kinds of bonds are held by insurance companies, pension funds, also banks to some extent, about $7.5 trillion. That brings bonds in total up to around about 12% of household wealth. So the rest, the variable income stuff, is actually 88%, almost 90%. I put it to you, it's very clear that the variable income assets are far more important than bonds in the assessment of asset prices. Economists really do need a theory of the determination of nominal asset prices. Now I'm going to, having said that, I'm now going to say something which I think is pretty straightforward and clear and not very surprising. However, there are many distinguished economists who would regard what I'm about to say as rather sweeping. And Robert Shiller, another Nobel Prize winner, has said that economics doesn't have a good theory of nominal asset price determination. Okay. We know that in the long run, on average, roughly speaking, the quantity of money and national income, nominal national income, rise together by the same sort of percentage. Possibly money rising a bit faster in many economies as people become more financially sophisticated, but they rise at the same sort of rate. We also know that rent and dividends are part of national income, and that they rise with national income, and often they rise at the same sort of rate. It follows that one would expect, in the medium and long run, the rate of change of nominal asset prices to be similar to the rate of change of the quantity of money. In other words, the so-called proportionality hypothesis says X% change in money implies X% change in nominal national income, applies also to the variable income asset component of national wealth. I know there's bonds, but given that the variable income assets dominate national wealth, you would expect when we see figures that we see all three things moving at roughly the same rate. Now, I gave this chart last month, this table last month. Appeared again now. This is American households numbers going back to 1946 to 2016. So what is it? It's 70 years. Personal income has gone up over 80 or 90 times. Net worth has gone up slightly over 100 times. Money holdings have gone up a bit under 100 times. The rates of change of all three are very close. That is my main point. Now, in the short run, all sorts of funny things happen. And, you can't be quite as mechanical as I've just been in setting out this argument. But when you think about big movements in the long run, the theory works. Look at the UK. Here we haven't got the good numbers going back to the 1940s. We've got them going back to 1995. Doesn't work so well. Personal income's up by, on average in this period, 4% a year. Net worth up by over 5%. Money up by 5.75%. Well, we can discuss why that was the case. They're in the same sort of ballpark anyway. I would just say before I finish that the movements in asset prices are much greater than movements in income in the short run. The asset prices are far, far more volatile than, and I would say this is part of the way that the economy reacts to big movements in the quantity of money. When you get big jumps in the quantity of money, you tend to get big jumps in asset prices. That then motivates extra spending. That then motivates increases in nominal national income, etc. The increases in asset prices tend to overshoot. They tend to be excessive relative to the movements in nominal national income, both upwards and downwards. The other thing is that when you look at the different types of money holding, money can be held by households, held by companies, can be held by financial institutions, you see the same kind of difference. You see that the financial sector money, the money held by pension funds, insurance companies, and so on, is much more volatile than money held by households. And surely these two things are related, the volatility of asset prices and the volatility of the money holdings of financial institutions which specialize in asset management. Okay. You can see this in the chart I've just done here of movements in financial sector money and aggregate money in the UK since 2010. See, that little red line is just sort of, actually, you look at the axes, you kind of 2, 3, 4, 5% year after year. Look at financial sector money, sometimes it's plus 15, sometimes it's plus 20. There's actually one value here, there's actually plus 80. And I want now just to focus on the very recent past in the UK to kind of draw out this message of the importance of asset prices to spending and the economy and what's happening right now. This goes back to 2016, We had the Brexit referendum in June, and there was worries about a recession. So the Bank of England reacted by a burst of quantitative easing. And there was a jump in money growth. Went up the annual rate to about 7-8%. But then there was a geared effect. This disproportionate kind of explosive movement in financial money. You can see it there, that 80% value just for a month. I'll do some of the values nearby. And it was, in fact, a strong period for share prices. Okay? They seem surprising. We thought we announced we leave in the European Union, share price is going to collapse, weren't they? No, they didn't. They actually went up very strongly. Then we have a sort of more stable period. And then in the last year, the last value we've got here is actually for November 2018. You can see that the red line is coming back down towards the 0 point. In fact, the annual growth rate is now down to 2.2%. It's the lowest figure since 2011. And you can see the financial sector money actually has gone negative. Okay, let's just get this, get this sort of. So what's happened? Well, house price inflation stopped. House price in London have gone down. The stock market's been rather weak. Now, people are blaming these developments on Brexit. And it's true enough that actually there are some problems in Europe, and maybe, but there could be problems in Europe whether we were having Brexit or not. The stock market actually been weak in America as well. They've also had rather low monetary growth. I put it to you, the reason for the current spate of weakness in these variable income asset prices is actually what's happening to the quantity of money. And this is part of patterns that we see time and again in these cycles. And it's not really being caused by Brexit. Debate and discuss. Thank you.